Welcome to 27 Topics. Today we're going to talk about taxes, and our guests today are Dave Krueger and Blake Krueger of Krueger and Associates. Take it away, Dave.
Well, we hope to bring some important information to you. Obviously, I don't know how many years we've been doing this now. It's been several, I'm sure.
That's right.
We will not go all the way back. We heard that before the show.
Yes, that is true. Start out with, there really isn't a lot of new items this year for your income tax return. There are actually some items that haven't even been approved that we had last year that they're still working on. For example, the sales tax deduction, if you can use that, that's still being looked at. The education deduction is still being looked at, and a couple other items are still being looked at. Whether or not those get approved between now and before you file your taxes is anybody's guess. They're still working on them, so hopefully they'll come through. With that being said, I might get into a few numbers here about who has to file a tax return. And basically, if you're under 65 and your income is interest and dividends, no Schedule C income or very limited Schedule C income or farm income, earned income, the number is $16,900. If you're both over 65 and all you basically have is interest, dividends, and Social Security, $18,900 is the magic number. Now, it doesn't mean you may not need to file a state return. Their limitations are less than that. Plus, you may be eligible for a credit if you're over 65, so it's always good to look at that situation also. This year, for a joint return, the standard deduction is $10,300. You compare that to your itemized deductions, and you take whichever is the larger. So I think that's an important number for people to know if they're filing a joint return. If you're single, it's $5,150. Head of household is $7,550. So for your own information. And also the personal exemptions this year have gone from $3,200 to $3,300. Social Security. I have a lot of questions asked on Social Security. And there's two aspects to that. One is what you earn as far as earned income, which is farm income, Schedule C income, W-2 income. If you're under 65, those things may apply and affect your benefits. If you're below age 65, if you earn $12,480 in 2006, like I said, W-2 income or those type of nature, you may have to pay part of your benefits back. That does not include interest and dividends. Now then, when you look at adding all your income together, interest, dividends, your Social Security, at least one half of that, and you're over a certain income limit, then you may have to pay income tax on that, even though you may not have had to pay back part of your benefits. For a single, if that adjusted number is $25,000, you'll pay tax on part of your Social Security. $32,000 for a joint return. Another item that I might hit on just a little bit is individual income tax brackets. People think, well, if I'm in the 25% tax bracket, I pay all of my tax at 25%, and that's not true. It's a graduated type scale, so you pay part of you may not pay tax on part of it maybe at 10%, part at 15%, and part at 25%, just that upper bracket amount. So I think that's a misconception that people don't really understand. So from there, I think I'll turn over to Blake, and he can talk about a few items such as itemized deductions, capital gains, and probably even hit retirement accounts.
There we go. All right. Itemized deductions. Probably the most asked question on itemized deductions, yet the least used itemized deduction is medical expense. Can or can I use it? Typically, most people cannot use the medical deduction. It is subject to 7.5% of your adjusted gross income. And for an example, so if you have $100,000 of income and you have deductible medical expense of $7,500, you've just met what is, you basically have zero, 7.5% of $100,000. Now, if you would have had $8,000, you would only have a deductible expense under itemized of $500. So medical is asked about a lot, but used very little. You cannot use pre-tax insurance premiums to figure this out. So if you are part of a Section 125 plan with your employer, those premiums do not count. Co-pays are deductible. health, and if you pay it out of post-tax income and you pay your health insurance premiums out of pocket, that would be considered deductible. Basically, it comes down to unreimbursed medical care expenditures. Another hot topic with medical expense is long-term care premiums. They are now also deductible, but the limits of the amount that you can deduct are quite restrictive. For an example, if you're under age 40 and have long-term care premiums, the limit's $280. And if you're over 70 and have long-term health premiums, the amount's $3,530, and everyone else falls in between that. So, as you can see, medical expense is very restricted. Next part that is deductible under itemized deductions is state income tax estimates. A lot of people have an estimate due in January, in this case January of 2007. That would be for 2006 taxes. One way to help group your itemized deductions and maybe take advantage is to prepay that January 2007 estimate and pay that in December of 2006. Charitable contributions, another big item. You can make cash contributions of cash or appreciated items before year end. If you have stocks that have a big gain on them right now and you don't want to sell them and pay the capital gains on it, you can donate that to a charity and not pay capital gains and deduct it at fair market value. So it has benefits by doing that. Other items that may help you is forget about having those garage sales and donate those items to charity. A lot less hassle to go through and price everything and spend the time and effort to list them out, and instead you can just donate straight to a qualified organization and take that deduction. Other ways to help group your items and maybe be able to take advantage of the itemized deduction is to prepay your January's mortgage, January 2007's mortgage in December. You can definitely get some tax benefit by doing that. Another item is sales tax. It was new in 2004. It's still around, but it's also one of those provisions that technically have expired, but may be extended depending on what Congress decides to do. You can take the greater of your sales tax paid or your state and local income taxes paid. Planning opportunities include if you have major purchases in this year or even maybe next year that you're going to buy a house or pay for a lot of the materials or automobiles, etc. Another hot topic or questions we get is gambling losses or gambling income. What do I do with those? How can I offset that? Well, if you itemize, you can offset your gambling winnings with gambling losses, but it's not subject to 2%, but you can't, if you have $10,000 of winnings, and $15,000 of losses, your losses that you can deduct cannot exceed your winnings. So if you have that, in that example, you would have $10,000 income, $10,000 of losses, therefore your deduction or your net effect would be zero on your tax return.
But the key is it does force you to itemize.
Yes, it forces you to itemize to be able to take that. And if you itemize, the other portion of this that people forget about is if you get that W-2G for gambling earnings, you're going to pay state and local tax on that, exactly, whether you itemize or not. So it's still going to be subject to a certain degree of taxation on it.
So if you do get the big W-2G, you've got to remember, even though you may have not itemized in the past, you may be forced to itemize this year in order to take the losses up to the winnings that you had on your W-2G. So
that's correct.
Something to think about.
From the itemized deductions, just remember it's the greater of whether you itemize or your standard deduction. Today's world, with mortgage interest rates that have been so low, a lot of people who have itemized in the past do not itemize now. Remember, you're not getting punished. You get the greater of the standard deduction, the itemized deduction. So it's going to work out in the long run. Next topic is capital gains I'm going to speak about. Capital gains are taxed at 15% if you are in the upper brackets. The 5% rate's still there for those who are in the 10% or 15% normal income tax brackets. A little planning opportunity down the road is if you're in the 5% capital gains rate, that after 2007, which is a year away, that 0% is going to replace that. So it's a planning opportunity down the road. If you have some gains and you're in a lower income, you might wait till January of 2008 to sell that stock. Qualified dividends is now used, or qualified dividend income now received is now taxed the same rate to calculate the individual's capital gain tax rate. So that's a benefit as well. A planning opportunity is if you have stocks that aren't making or doing as well as what you thought they would do, or you put money in and you're losing some money, you might consider selling those if you have gains on other stocks that you've sold to offset that loss or offset that earnings, and that way you wouldn't have to pay tax. You can net it out to zero. Just remember though, if you sell more than if you sell more loser stocks than winner stocks, that's still the max that you're going to be able to deduct over and beyond. The net effect is $3,000. Next item would be individual retirement accounts. Obviously, a lot of questions asked about that. In 2006, you may contribute up to $4,000 into a traditional or a Roth IRA. And also, if you're over age 50, you can add an additional $1,000 to that in 2006 and actually 2007. So if you're 50 and older, you can actually put in $5,000. And you have until April 15th of 2007 to fund that. Those of you in a 401k plan, in 2006, you could have put up to $15,000 in that. If you're over your age 50 plus, then it was $20,000. And those of you in a simple plan, you can put up to $10,000 in 2006. If you're age 50 plus, then you can put $12,500. Don't forget, if you're in a lower income, and you can still make contributions to your plan, and now there's still the individual tax credit for contributions to a plan. And that is a pretty good effect, especially if you're in the lower income and able to put money into a 401k, a Roth, or even a traditional, you can get a credit for that. With the retirement accounts, done with that, I think I will now pass it back on to Dave and let him talk about some business ideas and planning tips.
Okay. I'll give Blake a break here for a minute. There really isn't a lot of new changes in business deductions or income. The one thing that we always work a great deal with if you have a small business or a farm is we always look at the Section 179 for writing off your equipment. You can write up to $108,000 off in 1 year, assuming you don't expend something like over $430,000 in total purchases. So it gives you a big planning opportunity. You don't need to elect when you buy the equipment, you elect when you do the return. So it gives you an opportunity to see, hey, my income's up this year, maybe I ought to write part of that equipment off. It's a good planning opportunity.
Also, Congress has placed limits on writing off the big SUVs now. They're over 6,000 pounds. It used to be up to the maximum of the Section 179. Congress, I believe it was last year, restricted that to $25,000 now.
That's right. So there is limitations on a big SUV. The employee health insurance deduction, nothing has changed. 100% deductible on page 1 of your tax return. The other question we have a lot of times is on the standard mileage rates for 2006, which is 44.5 cents per mile. That is going up in 2007 to 48.5 cents. So for every business mile you drive, that's a deductible expense that you can take on your tax return. We also have available to us, again, is the domestic production activities deduction. I'm not going to get into a great detail because it gets to be a little involved when you come to what's available for deduction, what's not available. Basically, you just need to talk with your tax preparer. And basically, if you're in the business of producing something or you're in the farming business, that's available to you. If you're in a service business or a service industry, probably not available to you. The home office deduction, that is available, but it is restrictive. It has to be regular and exclusively used for business. And if you're in that gray area, be aware that that is a hot item for the IRS too. If you try to take something, try to take your home office deduction, make sure that you document that and you do have a room set aside and you meet all those requirements, because under examination they will look very closely at that situation. You can also, I mean, at year end, if you see your income's up, you can still establish like a SEP plan where you can contribute like 25%, up to 25% of your earnings to a SEP, and that can be established even after December 31st, up to the due date of your tax return. So that's something to be aware of, something to plan for. Now, I guess Blake gets to go back again.
All right, I will start on some credits that are out there, that most used credits, and maybe a new one or two credits that are out there. The dependent care credit is still out there, applies to children under age 13, which basically allows someone else to care for him so that the person can work. It's limited to the lesser of the earned income of the lower earning spouse, or $3,000 for one child, or $6,000 for two children. Maximum credit is 35% if the AGI is 15,000 or less, and it gets reduced up to the minimum credit rate of 20% is not reached till the AGI reaches 43,000, so it's a graduated scale through there. Child tax credit still out there, $1,000 for each dependent child who's under the age of 17 at the end of the calendar year. That $1,000 is scheduled to be the same for the next several years. And the good news about the child tax credit is it can be used to offset both regular income tax and AMT. And also the child tax credit is partially refundable. New credit that's out there that we've been getting several phone calls over is called the Residential Energy Conservation Property Credit. Basically, insulation deduction, you're going to hear insulation credit, all kinds of slang names out there, I guess you'd say. But basically what it comes out to is a maximum credit of $500 can be claimed in one's lifetime, with a restriction of $200 of that only for windows. So the max you can claim on windows is $200 credit. What it is, the credit's 10% of your qualified, or your cost of qualified treatments. Qualified treatment examples be insulation, windows, the metal roofs that are out there now. A lot of those have heat-reducing pigments that would also qualify. So there's several items out there that would qualify. This credit is only good for calendar years 2006 and 2007. So it has to be placed in those calendar years. And as earlier we mentioned that the Windows maximum credit is $200.
I might point out that is a credit. The $500 is a credit against tax. It's not a deduction. That's the credit portion.
That's right. So the credit's actually dollars in pockets compared to a percentage off that. So that's the difference. Alternate motor vehicle credit is out there now. It used to be above the line deduction, I believe, off the top of my head, and now it's been switched to a credit. Credit includes 4 different types of vehicles out there: alternate fuel vehicles, fuel cell vehicles, advanced lean burn vehicles, and hybrid vehicles. A credit up to $3,400 applies to hybrid vehicles and other IRS certified vehicles. A couple other things, quickly, I guess. Education credits. People keep asking about what kind of credits do I have when I send my child to college, what's available to me out there. The Hope Scholarship, available to people who, the person's just starting school for the first 2 years. It has been increased this year for the first time. It's gone from $1,500 per year per student to $1,650 per year per student. So it has been increased for the first time. It's based on qualified tuition, which is tuitions and fees required for the enrollment or attendance of an eligible student at an eligible education institution. Next credit that I will highlight a little bit is called the Lifetime Learning Credit. You can claim up to $2,000 per year per taxpayer. So if you have 2 students who could qualify for that, on one parent's return, that parent could still only claim $2,000 total. And that's based on 20% of the first $10,000 of qualified tuition and fees. The good news is that has a little more leniency on what expenses would qualify and would not qualify for that. Just a tidbit, you can't claim the Hope credit in the same year for the same student that you claim Lifetime Learning Credit. Student loan interest, people ask about. In 2006, the interest deduction is $2,500. And the newest one that's out there is the Qualified Higher Education Tuition Deduction. That's above the line deduction. However, this year it's expired, but again, maybe extended retroactively. That's waiting on Congress to figure that one out. As far as education, that's basically where we stand on the educational side of educational credits, and it's highlighted items. There's obviously more out there. Make certain that if you get to that point, talk to your tax professional about that. One other plan out there is a 529 plan. It allows anyone to make contributions on behalf of a beneficiary. There's some benefits. The control of this plan remains with the contributor. Funds can be shifted tax-free to certain relatives, and the earnings accumulate on a tax-free basis. So there are definitely some good plans out there, some state-funded plans or state-controlled plans out there that are very beneficial in the long run. With that, I'm going to pass it over to Dave. We'll talk about a little bit about estate tax rates and maybe gift tax.
Right. I think it's always, this time of year, we always get a bunch of questions on federal estate taxes, gift taxes, people wanting to give away something maybe to their kids. Basically, the estate tax exemption for 2006 is if your taxable estate's over $2 million. If it's under that, it's not subject to estate tax. It may be subject to Indiana inheritance tax, which is a lesser tax than the estate tax. The gift tax, you can give away $1 million to whoever you want to give it away to, and that stays at $1 million. There also is an annual exclusion. For 2006, the amount was $11,000. For 2007, the amount's going up to $12,000. So you can give away $11,000 of your assets on December 31st, 2006, turn around and give away $12,000 in 2007, and you really have no tax effect on your estate. It's not, the return is not even required to be filed. But that also, one of the things we'd like to talk about, maybe it's like a little summary here, is one of the things is in a good tax planning situation is to avoid big peaks and valleys. By that, what I mean is if you've got a lot of income one year, it's not a good thing to have no income the next. What you try to do is level those peaks and valleys out so that you're in those lower tax rates. As I talked to you before, just because your top dollar's in the 25% tax bracket doesn't mean all your tax dollars are taxed at that. Only the amounts getting up to that bracket or their tax, only amounts going over that bracket are taxed at 25%, or whatever bracket you fall into. So if you can shift income to equal out your income, that's what you need to try to do. In the long run, over a longer period of time, even though you may pay more tax this year, in the long run, you're going to pay a lot less tax. So it gives you, and also if you have a negative or you have low income, it's also a planning opportunity possibly, is that you could convert part of your traditional IRA to a Roth. You could sell off old assets. There's a lot of things there that you can do that would be beneficial when you got those low tax years, and you need to think about those things and plan, particularly maybe before year end. And one thing you got to remember too, paying tax is not necessarily a bad thing. It's a good thing. So, think about, you hear people say, well, I didn't pay any tax last year. Well, they probably didn't make any money. So that's something to always think about. Blake, do you have anything you might want to add for a few minutes?
Yes, just a couple quick rehashes on the residential energy plan. Just remember that is a maximum credit of $500 for a lifetime. That's not per year. I'm certain that's going to be a hard thing for the IRS to track, but it's also going to be a hard thing for those of you who may switch tax preparers all the time, because we won't have all the old information on that. But it is $5,000 or $500 lifetime on that. Back to the plan, the itemized deductions. Just a quick recap. Remember, medical. A lot of people spend hours and hours and hours tracking all their medical, and it tends to be useless time. So know about where your adjusted gross income is going to be, and don't spend all the time tracking all the medical and going through everything. They bring it in. They may have $2,000 or $3,000, $4,000, $5,000 of medical expense, and they spend hours trying to track it all, and it's useless to them.
Yeah, the best thing on that probably, if you think you may have a medical deduction, talk with your tax preparer before you go through the the effort or the hassle of trying to add everything up.
That's right.
To see if it's going to be beneficial for you to use.
That's right.
Because even if you do go over the limit, you still got to itemize.
That's right.
And if you standard deduction doesn't do you any good. So.
Is there anything else?
Right now, I think, Paul, it's been a pretty boring year for new things for income tax. So, I think we've kind of highlighted the main issues. Like I said, there hasn't been a whole lot of new developments out there. I wish there were, because it makes life more exciting for us as well, just trying to learn them and be able to implement them in our services. We would, once again, suggest that you understand, go and visit your tax professional to get your taxes done, because a CPA, is a valued service, and we go through continued professional education to be trained on taxes and other issues. So make sure you see that tax professional. Just reading the book sometimes doesn't put you in the right category, and you may miss or take deductions that you're not allowed to do.
And I guess your office is open.
Our office is open.
Jasper and Ferdinand, I might add.
Jasper and Ferdinand?
Jasper and Ferdinand. So.
Well, our time's up for today. We want to thank Krueger and Associates, Dave and Blake, for being our guests. And they have offices in Jasper and Ferdinand. You can call them at any time or stop by.
If you or someone you know has a talent to showcase or an event to promote on 27 topics, please contact this station